Let's try a test. Welcome on World Class Edge. I'm Fabio. We are starting, guys, and let's try to put one in the live chat to check if everything is working correctly. Of course, we will recover these 15 minutes that we lost for troubleshooting the problems, but it should work. And today I prepared for you a masterclass that will cover not only the auction market theory in the way I see the markets and the mechanics behind the price movement, but I would like also to share with you as a gift the method that I'm using in the cryptocurrency market from more than 7 years to time the market tops and bottoms on the Bitcoin asset, and an overview also to explain you the way that institutions load money in financial markets and how they create certain price cycles using the commitment of traders report. And then we will go on the template of Tom, that is the main educator of this course, and we will cover the execution that really helped me to win also the World Trading Cup and to be in the top ranking, the top 3 ranking in 3 different competitions in the World Trading Cup based on footprint execution. There are also some Italian people that know us. We started doing education in Italy, as some of you should know. And then we started to move with the project of World Class Edge on international market. And it's going pretty good. We just started, and this is my first live session in English. So be really kind with me on the pronunciation and the way I'm using the language. It should be not too much hard to understand what I'm saying. Maybe in the technical terms I will need to take more time to explain you deeply, but I think it's pretty good. The connection I'm checking is good. The microphone is good. Let's check here. I see already people connecting in the live. I ask you before starting 3 in chat that we start with the first topic of today, that is auction market theory. And I try to teach you the approach that really did the difference in my experience in financial markets, and the strategy that I'm using also at the moment to understand from the major time frame, from monthly, weekly, daily, so for swing trading and investment, to the lowest time frame like 5 minutes, 1 minute, or range period. All perfect. Some grade, good English, perfect. Okay, good. So we are starting with the first topic of today, that is auction market theory, that is the real price mechanic and the real way that markets move. So nowadays there are a lot of theories about algorithms that are able to move the market, about secret strategy or something like this. Unfortunately, this is not true. If this would have been real, I would already reach the billionaire status. The market is not moved by a predictable algorithm. The market is based on the interaction of supply and demand and the interaction between orders and fundamental drivers. Is not a let's click and let's start the algorithm, but there is a complex interaction of different operators in the market. And auction market theory is the more comprehensive understanding of how this complex mechanic works. Okay, so we will start with the understanding of price equilibrium. That is the condition and status of the market that you will face in 80 to 85% of the time. Price equilibrium means that between the supply and demand, there is a balance, okay? And in technical terms, this means that the market is not in a unbalanced behavior, okay? This means that the fair value, usually, in this market status is at the center of this two range, okay? This is the moment where traders have great performance using, for example, reversal strategies based on standard deviation or based on any kind of other technique to get market reversal, because this market behavior is really predictable, and this is stationary. It's considered stationary market. This is the same condition that traders that use statistical arbitrage or spread trading try to create with the synthetic asset of the spread. So they try to sell an expensive market and they try to buy a cheap market. Okay, this is based on the relationship between the two assets that they are considering in the spread trading. This is really common in the stock market. Okay. Should not be stuck. Let me check. No, it's working fine. It's working fine. It's not stuck, guys. I think it's the problem of the connection of this guy. Please put the name so I can call you by the name. The connection I can show you from here. It's perfect. There are zero lost image. So this means that the streaming is running smooth. If you experience some lag or the video is stuck, it's based on your connection problem. Okay, so let's give me one in chat and let's double confirm that that everything is working fine. It works. Okay, for me it's perfect. Working fine for me as well. Perfect. Okay, this is the condition of the market that I prefer to trade because it's really easy and we can make money on searching for different patterns in order flow. For example, you have already faced the concept of market absorption or market exhaustion. These are conditions that if we find when the market is in balance, okay, in a condition of balance, not imbalance, okay, are easy to trade and are perfect condition to add to a trade also if you are considering about going back to the fair value. The fair value is like the value that the different operators in the market accept. Let's make an example. If we have an iPhone in the day of the launch, okay, the market will price the iPhone really high from the day of the launch and the price will start rising because there is a lot of demand for this new model. Okay, so you see usually people waiting in line in front of the store of Apple. Okay, after a few days, the hype of the aggressive operators gets like tighter, and we see that the market start to retrace to the fair value. This fair value is the current price of the new model. Okay, so we reach a balance between aggressive buyers and aggressive sellers. This is considered fair value. This is considered a balanced market. When market conditions start to change, okay, so when the market conditions start to get different, we can experience the imbalanced market. And the imbalanced market is when the aggressive buyers are willing to buy at more expensive price, and this can be due to a lot of reasons. For example, let's make an example based on fundamental factors. Okay, let's take Moderna. Moderna is a company that during the COVID times played an important role in the creation of the vaccine, and the same I could say for Pfizer. Okay, what happens that this company were running smoothly before COVID. But after COVID, the investment and the appetite for speculators to monetize this opportunity in the healthcare sector and in the pharmaceuticals gets higher and higher. So this means that market operators are willing to pay worst price to buy and to be in the asset that they are interested in. This is considered aggressive buying. This is aggressive auction of market operators, and it's not a condition of balanced market. This is what usually the price action trader calls imbalance. The problem is that price action traders base the condition of imbalance on the candle. And I want to make a question to everyone that is present here in the live. If this is a buy candle, okay, and we are basing our analysis on normal candlestick, are we really able to see where the aggressive buyers, when the imbalance in the interaction between traders is present inside this candle, or are we blind? Are we trying to guess where the market could retrace? It's clearly visible that there is aggression in price, okay? But can we use information on where we should consider to step in on the candle, or we need to use order flow on this? What is your take on this? Let's try to put things in line, understanding why, to get completely the picture of auction market theory, we need to understand also order flow. And we need to understand that the kind of interaction that there is between buyers and sellers needs to be supported by objective data. And the only objective data we have in the market is based on interaction between buyers and sellers. So, for example, with order flow, we can see that in this exact price level, there is the majority of the aggression of buy traders, okay? So we see that there is a delta imbalance on this level. This means that when the price approaches this level, there is a higher probability of reversal in the market. Not because the candle is closed here and we can expect a retrace to 50% or to 75%. This is a statistical reference, okay? But the objective reference is based on price interaction, okay? And we will see this later because there are a lot of different interpretation of the footprint that we will cover in the following session, because this session was not scheduled. I decided to contribute to this because I wanted to give you my interpretation of micro mechanics of the market. Okay, so the strategy of Patrick Neal and Tom, it's one of the best strategy I've ever seen for swing trading. And what I could give to the community, of course for free for who paid for the course, is my take on how the deep understanding of market micromechanic with footprint can improve even more the execution part. It's clear till here? Yeah, I agree with you, Ferdi. I want to explain you this. I will go deeply inside this and we will cover also what you are saying, because it's correct. What you are saying is correct. It's called multi-time frame analysis and fractal analysis, but we need to go deeper into this to understand why order flow is superior. Okay? No, Alex, of course this will be covered. Of course this will be covered. Don't worry about this. We didn't finish the delivery of the course and of the content. We are starting now the process of live session. Okay? Of course, we will cover everything related to order flow. You will not finish the course without understanding how the footprint works. Okay? So, I'm starting to get you inside how the footprint is useful to us as traders. Okay? Then we will go deeply, and then in the next session, we will go full on footprint. We will see every kind of different footprint, how we can interpret it, and how we can use it practically, okay? So, this is the difference between price action traders and order flow traders. So, price action traders try to guess where the price could reverse. Order flow traders define exact trading areas based on the interaction of the orders, okay? And based on what the market is telling us. Is not discretionary. There is a discretionary part in the order flow analysis, but the majority is objective because it's interaction between orders. So the market is continuously shifting between price equilibrium and imbalance. This is the condition that is constantly moving markets. Of course, the reason that can bring us to price equilibrium, to imbalance, are different. We can have, for example, a fundamental event that is changing completely what is happening in the market and the outlook of the market participants. Let's make an example. If we are in a moment where the market participants are invested deeply in the stock market, okay, and we see the risk of a world conflict that is getting closer and closer. We see that, for example, that Russia is not in a good relationship with America, and the condition between Trump and Putin is getting harder and harder. This is something that will not happen, but let's make this as an example, okay? What will happen in the market is that market participants will start to shift their opinion on how they will allocate their assets and their investment, and the market will adapt. So it will go to a price equilibrium, to a condition of imbalance. So we will see capital outflow from the stock market. We will see a huge bearish day as the market participants start to step in the risk off phase. What is risk off? Risk off is a condition in fundamental analysis based on the adversity to risk in the market operators, okay, in the market participants. They don't want to have risk on their shoulder in the investment asset. They want to lower the risk of their portfolio, okay? So they start, for example, to hedge using gold, or they start to taking money out of the stock market, okay? Or let's make another example. They can decide to shift their investment to other assets. So we see in the moment, we see Nasdaq with a huge outflow of capital and the sellers getting really aggressive. So going from a condition of equilibrium to a condition of bear market in the asset and downtrend. And at the same time, maybe we see gold that sees the opposite. So we exit from the equilibrium market and we get aggressive, okay? So this is the baseline to understand auction market theory, and is something that is not used only in higher time frame, is something that we are also using in lower time frame, okay? Now we go in understanding practical this. I will use TradingView because it's more easy to explain on TradingView, and the charting tools on TradingView are really user-friendly, so I will use TradingView as a platform. Of course, you can use Sierra charts, you can use ATAS, you can use Volumetrica, you can use Go Charting, you can use any platform you would prefer, because the mechanic behind is the same, okay? Is the same. You have to understand how market interaction is based and how we can read the distribution of price to understand auction market theory. This is not based on footprint. We will cover the footprint later. Let's see. How important do you think is footprint on lower time frames? Because I know full-time traders who say on high time frame it's kind of unnecessary because we can scale into lower time frame. We don't need to get out on the exact tick like on lower time frame. I completely agree with you, Ferdi. I completely agree with you. I'm not using footprint on higher time frame than 5 minutes. Footprint for me, it's a market timing tool. Footprint for me is something that I can use to refine my entry. Footprint is something that it's a market timing and confirmation tool. So I'm using footprint when my narrative is clear, when I understood, for example, that this is an accumulation of price, that the auction market theory is pushing price higher. The auction is successful. It's not a failed auction. We have a complete breakout and we have the day that close with the bulk of volume, the value area that is the majority, the 70% of volume higher, okay? So the auction is continuing to get higher. The market participants are willing to pay higher price and getting aggressive on Nasdaq because they expect a continuation in upside momentum, okay? So on the next day, I will not consider a short on the market. On the next day, I will consider a follow-up. So if I'm trading, for example, the London session, I'm not trying to get a short. I'm trying to get a long. So I'm trying to step in this movement of the price. How can I step in and be precise on my entry? I use Footprint. It's more clear to everyone in the chat how I'm using Footprint. Footprint is market timing, is not giving me narrative, okay? The narrative that I'm getting, it's based on price action, market profile, volume profile, VWAP. You can use any kind of analysis, okay? But it's not execution. The execution is based on Footprint. This is my view. Okay, Rocky, very clear. Awesome explanation. 100% clear. Perfect, perfect. Andrea is doing hashtag deep charts. Yes, guys, soon we will be able to provide a platform that will completely change the industry. We are trying to get something that is extremely valuable, intuitive, and it's easy to use, but at the same time, it's for professionals. This is our challenge for 2025, and we will reach it. For the moment, you can use any platform you want. After some months, you will not need to use other platform because we will provide template on our platform. Okay, perfectly, 100% clear. Okay, now let's go on. Okay, let's go on the explanation of this. What I'm using, and I will give you the exact template that I'm using. We can create this together. I am using the value area high, value area low, and I'm putting them with a lower contrast, so I can see immediately where 70% of volume is being traded in the asset. This is the profile. Remember that on TradingView, we don't have actual volume. So I'm explaining this to you as a reference. But if you want to have the best possible volume on the asset, you have to use a data feed, okay? That you can use CQG, you can use Rhythmic, you can use DX feed, you can use whatever you want. And usually when you get a platform, it's included. Okay, so you have a discount on this. Now let's go on colors that are not too much expensive on our eyes, and let's make the color a little bit more visible, a little bit more dark in the inside where 70% of the volume is exchange. And let's also increase, you don't need values because these are not actual volume, okay? Let's go on inputs, and you can put row size to 100. This is what I actually use, and I'm using TradingView a lot because it's really user-friendly, okay? I need this not to have the exact point where the contracts are exchanged. I use this as a reference, okay? So what I'm seeing now, I want to make an exercise with you. Let's remove price. Okay, let's remove price and try to understand what is happening based on where 70% of volume are exchanged, okay? Now, if we start from here, what is the market saying to us? 70% of volume are exchanged here. Let's make this white, okay? The day after, close here. What do you think from an objective perspective? Let's not put any subjective interpretation on this. From an objective perspective, is we have the values of the profile area, 70% of volume here, you think that market participants are willing to accept higher price, are willing to accept more expensive price? If the aggressive buyers are pushing price up, the probability that we will continue the trend will be higher or lower? Of course it will be higher. So on the next day, I can expect a follow-up on price. And the next day, this is how I use market bias, how I create the first step of my analysis. And I use colors. So as soon as I am holding a market condition that is confirming that the traders are willing to pay higher price, I will continue to add to my position. Okay? Now, we still have not closed the day, but if the day gets closed, for example, let's say here with this area, I will have the first day where the auction of market participants is willing to retrace. So we are getting to the next fair value, and the next fair value that we can see in this market is this one. So if we close the day like this, there is a high probability that on the next day we will check this level. Based on what? Based on fair value of the previous day. It's clear? Let's put one in chat if it's clear. Ferd is saying, but getting precisely in for swing trades then will be the 15 minutes, right? No, not necessary. Let's take, for example, my strategy in the World Trading Cup. The last World Trading Cup that I did was on futures. It was audit results and I achieved 218%. I did more than 500 trades in 3 months. Okay, so it's really stressful. I was not using 15 minutes. I was using the combination of 5 minutes and 1 minute. 5 minutes was my bias. 1 minute was execution. So I was using, for example, let's say VWAP and structure on 5 minutes and execution on 1 minute time frame. Okay? What I'm explaining to you is that you cannot mix different strategies pretending that you can put everything in one. For example, if I'm trading, let's say, crypto, okay, and I'm working in the analysis of the on-chain metrics of the blockchain, I cannot expect to use the same stuff on S&P 500 because the market drivers are completely different. If I'm trading the footprint as an execution tool that is a really short time frame, I cannot pretend to do swing trading with footprint. It makes no sense. If I'm trading footprint, if I'm trading swing trading, I will use the data that gives me an insight of what institutions are doing on the long term. It makes no sense for a weekly position to have an headache to understand the perfect reversal point from footprint. Is this clear? This is for the whole day, Marco. Is it clear the point that I'm trying to make? Sometimes getting things more complicated doesn't mean that you will get better results. You have to have different models, okay? The model of Tom and Patrick, it's more on long term. You have to take the lesson that I'm giving today as a way to implement the auction market theory and footprint for short-term traders. Okay? Not something different from this. Perfect. Now, let's go to continue this analysis. Okay? If I want to get additional insight on how I can pinpoint the exact imbalance in the market, there is a way that is completely objective. And it's not using candles. It's not using candles. Okay? So if I want to, for example, I close this day bullish. Okay? I close this day bullish. Perfect. And I want to see deeply, I want to zoom in and check in this profile which kind of profile we have. We have a balanced profile because the tails are almost the same. You can see from here, okay? These are the tails, the Gauss distribution. And we have where 70% of volume is exchanged, okay? This is the value area low, okay? This is the value area low. And what I can see is that there are exit points where the volume is really low. This is imbalance. This is imbalance. And I can exactly define which areas are the one where I have the less volume. This is a sensitive area. This is an area that I can use, and in the World Cup I've used, of course, as a potential reversal. Okay? So when the market gets here, I will not try to get the minimum of the market, but I will wait for the footprint to give me confirmation of aggression. Okay? This is the concept of falling knife. Okay? What's the probability that I can get a knife that it's falling? The probability that I will get it without cutting myself is really low. Okay? If the knife is sharp and is turning, because I don't know what, in the moment that I will get it with the ends, if I will get the handle or if I will get the blade. But if I wait that the knife hit the floor, I have the time to get it by the handle. And you will say, but you are not getting it in the perfect moment. No, I will get it later. I will lose some profit, but I will be more precise in what I'm doing. Okay? I will be more precise in what I'm doing. Now I'm trying to understand, no, don't take this market, don't take this as a way, the only way to use the profile, okay? You have to use the profile in the way that your strategy is using it. For example, how Patrick Neal and now Tom are explaining. Right now, I'm explaining how the auction market theory works, and I'm using TradingView only for convenience, because it's really convenient to explain here as a charting tool. It's really easy to draw, so I can go in details. I can draw on the chart. It's not really user-friendly to do this in Sierra charts. Okay? Now, I'm trying my best with the English. Okay? I'm trying my best with the English. I hope it's clear what I'm trying to explain and the point that I'm trying to make. So what I'm trying to let you understand is that the sacrifice of this portion of profit is raising my win rate by 20-30%, because I'm not trying to get the market reversal, the market bottom. Okay? Of course, Pankaj, you can do this with Serge. Serge is expert in this. I'm not using DOM. I'm using the footprint, okay, as a tool. So I can give you my insight on the footprint side. Clear, thank you, clear, perfect, okay? So now let's go on. On the following session that you can see here, we have a profile that is not balanced. This profile is called P-shape, okay? And why it's called P-shape? Because the majority of the volume is on the upper part. So we have 70% here. Yeah, 70% volume here. Okay? And what I'm seeing here is that I have different points where there are imbalance in the market. All these areas, it's almost zero volume. So these areas will become a level that in the following days can be used to pinpoint market reversal, especially if we are holding the structure of the auction market theory. Okay? The same I could say for the second level, and the second level is this one. The market didn't reach it. Okay? You can also merge these two levels. What I will do here is the same. I will step in when the footprint is giving me the confirmation, and we will go deeply in the following session to explain about the footprints. Okay? Market follow-up. I can go on, for example. I have this profile. Let's go on the yesterday profile, okay? 70% interaction is here. The profile that I have is P, so the market buying pressure is really high on this. What I'm seeing right here is that if I zoom in, I can zoom in on this, expand the price, and I can check that if I put a vertical line here, the lowest level where I have the less volume is this one and this one. I have these two levels, so I can use this to pinpoint possible market reversal. And this is exactly what the market is doing here. Now, what can happen here? The market is balancing. We have a balanced profile here, okay? We have a really balanced profile. But now we are seeing some kind of aggression. So market participant is getting aggressive on the buy side. And what can happen here is that we have a follow-up going to the value area I here. Okay? And at the same time, considering how the value area is developing, we can accept this low and doing a follow-up to this level. Okay? But what we can say is that in the actual structure that we have of price, of following up of auction market theory long, it's more probable that we accumulated on this price level that is based on imbalance in the price, and that buyers will get aggressive on this, and we will continue our action, our auction market till this level. It's clear, guys? Let's put a 2. Perfect. It's getting clear. Good. Now, this condition, it's a red flag for us because the market is building value lower. But we will not accept this condition till the day end. Okay. Now we are still in the New York session, the session with the most volume. So we still can rebalance the value area to this point, closing the day with the price, for example, here. This will mean that the probability of the tomorrow auction will be higher. I see all 2 in chat. Perfect. Now, this is the way that I want to explain to you the auction market theory. Now, let's make some clarification. The majority of swing trader and intraday trader don't take all the day. They take only the session because it's where the majority of volume takes place. Okay? What I did today was to explain you how the market moves. Okay? How the market moves. And it's the same. The procedure is the same. But the filter that you can use is different. You can take as a reference one session. You can take the whole day. For example, on Nasdaq, I only trade New York session. So for me, London session is useless. Okay? But to explain to you the whole process, I'm taking the day because I don't want to cut out market action. To explain you how the market develops in the full day. It's getting clear now, Ferdi, also for you. How many times can a low volume node produce a reversal? The second time is less like, this is the same as Sam Seiden fresh area. What was Sam Seiden saying? That the more time, the more the price is stationary on one level, the less effective the level gets. Now we don't have a probability that if the price reach one low volume node, it will reverse. It's impossible to do this. Why? Because it's not algorithmic trading. It's discretionary trading. So we use, for example, the confirmation of the footprint to validate the level. We use the concept of bias. What's your pressure, your narrative? My narrative today on Nasdaq is long. Okay? So from this level, I would have considered long position. From this level, I would have considered long position. Okay? This is what you need to understand. You don't have an indicator that is saying 70% of the times that you reach this level, you will reverse. It will be a money printer. You could not fail as trader like this. It will be too easy. Okay? Perfect. Okay, also for Ferd is clear. Yes, as Andrea is pinpointing, you can use just cash session. Now, I want to go on the longer time frame, okay? Because I received a message from a student of World Class Edge that was saying, Fabio, I don't understand your Italian lessons, and I want to get clear understanding how the auction market theory develops on a higher time frame. To understand this, we have to understand how market participant moves in the higher time frame. And to do this, and this is considered investment or swing trading, I want to let you understand one position that I've taken in copper, okay, the futures of copper. And to make this, I have to go through two different explanations. The first explanation is the concept of bank report. The concept of bank report is market research report made by institutions and hedge fund. Okay, and this is something that is free, that you can get. You need some time to do research. You can subscribe you to, for example, HSBC research department or UBS research department, or you can just follow on LinkedIn different people that are publishing the market outlook of the major hedge fund around, or banks. One that I really like in the way that is structured is Goldman Sachs and Morgan Stanley, and the one of UBS, it's really detailed on price targets. And what I was seeing, let's go on copper. And this is based on what Ferd is asking, because as you can see, Ferd is asking for longer term time frame analysis, like swing trading, okay? So we were here on this level, on this demand, when the report of UBS came out. And the report was saying, considering the actual price of copper, it was around here, I think, around here, I don't remember, we are really discounted to the metals, to the other metals, and this is called, this is what is called intermarket analysis, okay? So you can run, now I don't want to go deeply into this, but you can run co-integration test to understand how the different metals are related between each other, and copper, it's a little bit lagging, but at the moment you can see that the historical, I think it's pretty visible that the historical correlation is really high, and that usually they recover each other. when there is, for example, a movement that is not supported by the benchmark, the other asset is recovering really fast. This is considered co-integration of the asset. Okay, it's considered, and it's a statistical number. In this moment, we saw that while copper was making a lower low, the benchmark of the metals, so I'm talking about gold, I'm talking about copper, I'm talking about silver, sorry, was supporting higher price movement. Okay, higher price movement. This is called in the intermarket analysis. Now we can go deeply inside the concept of how institutions use and developed auction market theory to fill their orders, to build their position. Is clear? Give me a 4 in chat if my English is getting better and understanding what I'm saying, and if it's clear what I'm explaining. So, to make a recap, we started with an explanation of auction market theory using the profile distribution. So 70% of the daily volume of the asset without filtering the cash session. Okay? Then we understood how the footprint from the theory can be used as a market timing tool and as a better level to understand how the price develop and the probability of reversal, which area we can take into consideration. Now we are going on the higher time frame because I want to let you understand and to reply to the guy that told me, how can I use the COT data to understand if institutions are accumulating or distributing price? And this is exactly what I'm going to cover also in this session. Okay? Perfect. Now, let's go on. What we can see is, this is the legacy, okay? Different kind of market participants. The non-commercials are hedge fund, asset manager, leverage money. These are people that are speculating that the price, for example, in this moment will rise. And I will explain you why, because you cannot take only the number. You have to understand what is happening, okay? Commercials are market hedgers. So they are usually on the opposite condition of the market, okay? And at the same moment, we can see, as you can see, they are opening short. And if they are hedgers, this means that the probability that the price will continue higher is really high, okay? And then we have no reportable. No reportable are usually retail traders, okay? Now, let's go on. From this snapshot of the last release of the copper, we can see that the non-commercial closed a lot of short position. At the same time, they closed a lot of long position. But if we have to understand what is happening, their bias and their outlook is long. Can you explain me why the outlook is long? From this? Because they are weighting down on the assets, but they are weighting down more shorts than longs. Okay? And at the same time, we see the commercials that are hedger going short. This means that the probability that we will reverse on this box on copper and go higher, it's really high. The same was happening here. And this is support at the same time by the intermarket analysis. It's getting clear, the picture. I want to go deeper into this, letting you understand why this is really important. Let's go here, okay? So as you can see, the correlation between non-commercial and the direction of the price is really high because they are trend followers. They are adding position and pushing price lower. At the same time, when you see them accumulating, the price is getting an explosion really, really fast. When they are loading down, weighting down, the price gets lower. At this moment, the price is having a deep correlation between asset manager, leverage money, that of course are non-commercials. So this level was confirmed by the institutions to go high. It's getting clear what we are getting out of this. And what I want to explain you is that this kind of traders cannot put their orders here. They will start to load on the asset, fragmenting their position. Okay? So, for example, if they start to expect that copper will recover this high, they cannot just enter inside this week. It's impossible. We are talking about huge volumes. So they will fragment their orders. And they will start to weight down their orders, accumulating and distributing price. Is this clear now? One-to-one in chat. Perfect. This is how the market moves. Okay. I want to make you another example. This is one trade that I got on the free live session that unfortunately I'm doing in Italian, but I will make my best to provide them in 2025 also in English. And this is the level where I took the Euro USD short in live. Okay. After getting another short in the global macro bootcamp that we were doing in Italy here. How is it possible that you can time market like this using institutional data? This is possible because when you understand how the market is moving, the markets are moving. Let me go on Euro, got legacy. Let me go directly on chart. And I want to let you understand something. Let's remove non-reportable and let's remove commercials. Okay? Let's go higher on this. So this was my short. Watching this chart, these are the big traders. Okay? Asset manager, leverage money, they are coming inside a position not to have a look around. They are coming inside a position to get money, to extract money out of the trend because they are speculators. And if you can see here, it was September 17, around this level, okay, around this week, this distribution, they start to load a lot of money short, and the next Scott report is extremely short. The next week, extremely short. September 24. We are here. After this, we can use auction market theory to understand that from a balanced market, this was in a condition of balance, we are capitulating short, creating what? What I explained to you, a condition of imbalance. And why this imbalance gets created? Because the big traders are extremely short. We are not anymore in a condition of balance. They have created their distribution of price. Okay? And now, the real trend is starting to get short. There are a lot of websites for Code Kelvin. It's free. You can go on CFTC, you can go on TradingStar, you can go on bar charts. There are lots. It's free data. I'm only trying to let you understand how this data is giving a perfect explanation of the auction market theory on higher time frame. On lower time frame, I'm using the profile to show you. And then you can customize the profile as you prefer. You want to have a snapshot of the cash session? Do it. You want to have the full day? Do it. You want to filter? You notice that there is an edge, a statistical edge in the market. If you take from 4 p.m. to 8 p.m., use it. But the condition behind what moves this market will not change. It's an interaction. It's not an algorithm. Okay? I will stop for a second. Before going on the understanding of the crypto assets, because I want to save 15 minutes to talk about what created more than half of my fortune, understanding the price cycles in the last 7 to 8 years on Bitcoin. So I want a 5 in the chat if everything is clear on how the market is developing a distribution or creating an accumulation. And then we go on. We go to another market to understand that every market is different. And you have to understand before the fundamentals behind, and then you can trade. I see a lot of 5 in chat. Perfect. Let's go on, guys. So we go to this platform. I really advise that you take a look at this platform, and I will make it easy for you. Okay? This platform is free. It's called Check on Chain. I was extracting this data with a lot of effort before and paying for them from Glassnode. You know Glassnode. It was costing a lot. Then this platform came out, it's free, and you have everything you need to time the market of Bitcoin, cryptocurrency. And I will explain you my favorite models based on the fundamentals of the asset. There is someone in the chat that is on the run of the asset, getting a long position, Bitcoin, holding a long position. And I will start with the originals. The originals is, you can see this as a VWAP, but it's not based on volume. It's based on different metrics, creating a concept of discount and expensive price. This is not Fibonacci. It's not a line in the chart. It's actual data. Okay. It's based on realized price. It's based on miners. So what I want you to do to filter on this is removing some lines and only watching the true mean of price, so the fair value of the asset, and the discount price and expensive price. I'm pretty sure that if there was this masterclass on YouTube for free in English, 90% of people that will take 10 minutes of their time to understand what I'm saying will never lose a lot of money on the euphoria of the crypto. Okay. Why? Because Bitcoin is not different from other assets. There is a benchmark, there is an ecosystem based on fundamentals and miners, and there is a discount price. And what I did for the last 7-8 years was buying when it was discount. When everyone was thinking I was crazy, Bitcoin is a scam, I buy. China is letting Bitcoin become something illegal, I buy. The hash rate is dropping down, FTX is failing, I buy. Why? Because the asset is discounted. If we are at an auction, okay, and we have the new model, not the new model, the old model of the Mustang, 1969, a car that is costing a lot, and the market price is 120,000 euros, for example. And in the auction is starting at 60,000. Will you buy the car? Will you make an offer or no? Of course you will make. Because the value of the asset is more than what you are paying to buy at the moment. If the auction is getting to 340,000 and the actual price of the car is 200,000, you will not even consider offering. Why? Because you are paying more than double. Is it clear, guys? Let's take a one in chat if it's clear. This is the first model and is based on price location, understanding where we are in the cycle. I'm not putting a time in tool. I'm not even considering the halving, that is the biggest event of Bitcoin. I'm only considering price location. Are we expensive or are we discount? Okay. Another pricing model that I want you to see, and you will mind blow, is the cycle oscillators. This is not discretionary. This is another tool that I've used for a lot of years. It's based on valuation model, on reserve risk, fuel multiple, SOPR, and MVRV. Now, we don't have 2 hours to go deeply inside every one of these. But what these models are doing is creating a benchmark for the asset and flashing whether every one of these agree that the market is discount. I will ask you for a confirmation in the chat for a 8, that is the number of wealth, if you will be extremely happy to have in your portfolio Bitcoin from these price levels. Of course, yes. Okay? And someone could argue, but this was only in the past. No, guys. The pool multiple is here from more than 7 years. The pricing models are here from more than 7 years. And people still don't understand how you can consider an asset expensive and how you can consider an asset discount. People lose money in this market because they don't understand what moves the market. They go on the hype, they say Bitcoin is 100, it will get to 200. Why? I don't know. I want to show you something funny about the crypto industry. On my LinkedIn, I had a post some time ago. Okay, this is my profile. There are the performance, the World Cup, the CME Group Cup, and I did this post about why the fundamentals of XRP are extremely strong in the asset. Why the regulatory development is going crazy good. Why the adoption in financial system, the utility is crazy. Why the opportunity, the macroeconomic opportunity is really good. And why the sentiment was a contrarian play. Because we had the SEC that was holding XRP down. But thanks God, I'm investing the same in all the assets and I'm not putting my money if I don't have a confirmation. When we were at 40 cents, the valuation of the network of Ripple was $2.8. For you, is this a deal or no? Is this a deal or no? When I got again Ripple at $1.2 live, the valuation was getting to $7.5 to $8. From the moment of the post, we already reached 3.5. Another 30% in the asset. Okay. And what I see is a lack of understanding of how you can understand if one asset is worth it or no in a certain moment in history. Okay? This is what I'm trying to let you understand with this. This is also considered auction market theory, because it's the interaction. You can see the way that a market develops an accumulation or distribution. It's not immediate. You start to build. And we have the same basing ourselves on the COT. If we want something similar to the COT in the crypto assets, we can, for example, use the position of the biggest address in the market. Let's go to check them. Would you agree that someone that have more than 1000 BTC in the wallet knows something more than you? Of course, they know. Look what they were doing. Why here so much? Is it getting clear, the picture, for you guys? Where did you find the price evaluation indicator for XRP? I didn't find, I created it. Because when I want some information, I create it. It's not public. Something I created. It's a formula. It's based on the value of the network, on the transactions. And I will publish a research paper on it when it's the time. Okay? And this moment, this was what institutions were doing at the moment. Okay? The mega whales were buying hard. They were buying hard also here, before the explosion of the price. They were selling extremely hard here. Why? They were selling extremely hard here. Why? Okay. This is how the market moves. What are they doing now? They are buying or selling. They are liquidating the position to some stupid retail that is trying to get rich. They are selling their position, loading down, weighting down on the asset. Intermarket correlation third is free. You can just search the relation of the asset between themselves. It's not something I created. Something that is public, is free. It's like COT report. You can search for the correlation of the euro dollar, and you will find it that is correlated to the British pound and to the dollar CHF. Inverse, negative correlation. It's free. You can search. Okay. You don't need videos. Just need to get the time to search on the correlation table which asset is correlating to your asset that you are analyzing at the moment. Would you consider crypto trading other asset? I was trading other asset. Then there was the disaster of FTX, where I lost a lot of money. Now I'm just holding, loading down and liquidating position at the right moment. Okay? So I was interested in sharing how I'm also using this to time my investment in the crypto industry. Okay? And I'm mainly trading and investing in Bitcoin and Ripple. I'm not as interested in anything else. At the same time, we have also the levels where the position can get liquidated, where we can take profit from our position. It's called P-cycle top, and it's based on statistical analysis of the market top. Let's go on. Let's go on the first overview of the footprint that we will cover deeply in the live session of the next week. The footprint is a tool that is resembling a candle, a candlestick, but you can see numbers in it. This interaction between bid and ask. Okay? Now, in this template, that is the one of Tom that he will share with you, you will see blue colors. Let's focus on colors, okay? We will go on the bid ask next time. I will share with you some image of bid and ask volume on the footprint. We are already live from 1 hour and a half. I was not even realizing. I was thinking we were live from 30 minutes, 40 minutes. And what we can see here, it's delta. It means, for example, that buyers are more aggressive here, are more aggressive here, are more aggressive here, and are more aggressive here. This is an example of absorption, where the volume is not having a follow-up from price. Okay, this is a failed auction. Try to break the market high, but it gets absorbed. The volume is not having a follow-up on price. We'll go deeply inside this. Okay, and this is sellers' aggression. So what we are seeing is that sellers are getting absorbed on these lower boundaries, and buyers are getting absorbed on this one. This one seems to you more of a balanced market or more unbalanced market? Give me an explanation of this. I will wait. I go to take some water in the meantime. Let's check the chart. Exactly, it's correct. It's balanced market, okay? In balanced market, as I was saying before, you will see this pattern of market getting to the extreme, and you can see aggressive buyers trying to have a follow-up, but they get absorbed. Why absorbed? Because even if you have a lot of buying delta on the top, the candle is red. So what is happening in this moment is that all this aggressive pressure is getting absorbed. It's like punching a wall. And the market gets back inside the range. For example, a trade in this case will be recovering from this level the fair value, that is already a 1 to 2 risk to reward, or the lower part of the boundaries. Okay? And in the Gauss distribution, we have the fair value that gets hit 70% of the time, and we have the outline, the outside parts, that is less likely to get hit in a balanced market. Okay? But at the same time, we have to be really understanding what the cumulative volume delta is doing. Because in this time, there is a selling pressure that is developing. So if from here we see again aggressive buyers getting absorbed and we start to approach this level, I will not try to buy the market here. Why? Because the cumulative volume delta is a reflection of the pressure of the order. Is the cumulative volume delta. So it's the delta of the volume. And the delta of the volume is balanced till this moment, but then we see a lot of aggression. So if the market from here starts to get down again, and I see a lot of sellers' aggression, there is a high degree of probability that we will switch from a balanced market to an imbalanced market. Okay? Exactly. Exactly, Anthony. Limit sellers absorbing buyers. Is it clear? I'm trying to explain this as easy as possible. Of course, we can use a lot of confluence on this. Let's say, for example, that we have a market structure and an auction market theory that is short. So the market is developing like this. We have the profile, and we are here, okay? And we see this condition with delta starting to develop shorts, buyers getting absorbed, and then we see a breakout of this level with aggressive sellers from the 1 minute, the time frame to time the market. Would you agree that from this confirmation I will get a better entry point and I will get a higher probability of a follow-up? Is it clear, guys? One in chat before going to continue on this. I was not expecting the live to be so long. I hope that I'm not boring you, annoying you, and because I want to show you all this example before closing the live. Perfect. Clear. Thank you very much. Okay, now let's go on to another example. Let's go on this example. The first thing that I want you to understand and to give me a reply, it's dividing the market in two phases. I want you to define how would you consider the phase 1 and how would you consider the phase 2 if you are talking about balanced market and imbalanced market. How would you define, for example, phase 1 balanced market, phase 2 imbalance, or reverse? How would you consider this? Please make a comment in the chat, switching between phase 1 and phase 2. We have in this case, in the meantime that you reply, we have on this condition a phase 1 that is imbalanced market. Why? Because the market is getting really aggressive higher and is completely not balanced. The moment we are reaching a level where the sellers start to step in, the aggressive sellers, we reach a balanced market. So for example, if we are in this condition, okay, in the same condition as before, on this level, okay, we have an area, we have the possibility of continuing down, lowering down, okay, and we see the market getting absorbed, the sellers start to getting really aggressive here and start to auctioning down, you can see, okay. At the same time, we have an upper boundaries and the lower boundaries. And we see that when buyers try to get aggressive on this, they get absorbed. Okay. At the same moment, the sellers that get aggressive on this get absorbed. So we have a balanced market. Now, if this structure gets broken, this balanced market gave us our confirmation. We can go sell. What's the problem in this? What's the problem in this? The problem is this, is that we need to consider how the delta is developing, and the delta is developing higher. This means that there is more probability of a continuation. And at the same time, we have a huge risk of reversing at this level. Why? And we go back to the starting of the session, to the starting of the lesson also, where I told you from the candle, you don't have a clear understanding of where the bulk of volume is. What created the exiting of this balance? This level. So what can happen here is that the market creates a fake out, a spike. Don't create a break of structure, get absorbed back again, and we continue higher. Why this live is golden? Why this understanding of the market is golden? because this can make a difference. This can be the reason you tell, I don't like this setup, and you save a stop loss. Not for something subjective, but because you understood how to read the market interaction between participants, the delta, the footprint. And of course, if you want, okay, I'm giving this to you as a bonus. Also, the next week we can do another session also on footprint. Complete 1 hour of training on footprint. Practical example, how can I execute on this? Okay? Let's go to the other example. Completely imbalanced market. The auction is getting higher and higher and higher. And as you can see, when the market is getting ready to break, loading, aggressive, holding here, till the moment the price explodes. From where? From this area of accumulation. It's not maybe it can be here. No, it's here, I can see. It's not something I try to guess from price. I see from volume. And this is exactly the level that gets retracement and then follow up. If we consider this breakout started from all this order loading and having a follow up. And this is exactly the level that the market retraces. And then another breakout. But now we see the delta starting to get down. So I will not try a follow-up on this because it's getting really risky. There is a possibility that from here we start to get back to the balanced market. So it's not worth it to take a trend following trade. Let's go on the last example. Condition where the delta is building higher. Okay. Stable condition, no delta sell. Even if the price is breaking, the delta is stable. The aggressive sellers are getting absorbed. Till the moment the price define a breakout of structure here. And then when the market is retracing, also the volume is supporting a breakout. So we have a balanced price in the distribution, okay, and a high probability of the market breaking again higher, confirming our setup. And maybe we can time this condition with any confirmation that you got from Patrick or Tom. Maybe you have a buy area. So you are only starting to consider what I'm saying to you when you are approaching this area. Not here, not here. You have to build before a narrative and then an execution. Okay? Jose, I'm using 1 minute, but the market is fractal. This works on 1 minute, on 2 minutes, on 5 minutes. Remember that minutes is something that we human created. The market is based on interaction of orders. So the market don't care if you're watching 5 minutes, 1 minute, 3 minutes, or 4 minutes. What is important is the interaction between participants. And the market is fractal. Guys, I really hope that after this 1 hour and a half, you will take 20 seconds to go inside the Discord, in the feedback section, and let me know if you are appreciating this bonus value live that was not included, was not scheduled, but really I'm trying to get this to the more practical level as possible. We are hearing your feedback and implementing really fast, getting the best experience of learning that you can get in the market right now on the educational side. I really hope this will be appreciated. We went from understanding of auction market theory to understanding of the value of the footprint to the defining of intermarket analysis and COT report and how the markets create accumulation and distribution on higher time frame. Then we went to understand the fundamentals of the crypto market, and then we close with some practical example of footprint that if you like, and I see a lot of feedback, I will continue for sure to do, maybe in the next week and maybe also in the week after, till the moment you don't understand everything. Thank you very much, guys. See you in the next live. Let me know if you like the session, and I will see you. I will read as soon as I finish this, the feedback section, to know if you appreciated the live. Have a good day. See you soon. What is the start time of session volume profile? The beginning of the day, the one I was using. The footprint is based on 1 minute and 5 minutes. You can decide it. Have a good day, guys. Happy session.